During the writing of the new tax bill, members of Congress, particularly members of the House, discussed curtailing or eliminating many deductions popular with taxpayers. Now that the bill has been finalized, many taxpayers are left wondering, what deductions can I take under the new tax law? There are two different types of deductions that taxpayers can claim to reduce their taxable income. One is the adjustments for adjusted gross income. These are reported on page 1 of the 1040 and include deductions for IRA and HSA contributions. The other broad category of deductions are the itemized deductions. These are reported on Schedule A. You only report itemized deductions if your total amount of deductions exceeds the standard deduction. Itemized deductions include 7 broad categories: medical expense, state and local taxes, interest expense, charitable contributions, casualty and theft losses, 2% miscellaneous deductions, and other miscellaneous deductions. The tax law made changes to many of these deductions. We will first cover the change to medical expenses. One of the deductions the House considered eliminating was the deduction for medical expenses. That did not happen. Instead, the new tax law makes it easier to deduct medical expenses by decreasing the threshold to claim the deduction. Medical expenses are only deductible when the total amount exceeds a percentage of your income. For 2017, this threshold was supposed to be 10%. The new tax law reduces the threshold to 7.5% of AGI, but only for 2017 and 2018. So, let's assume you have $100,000 of income for 2017. Under the old law, you would have had a $10,000 threshold. If your medical expenses were $9,000 for 2017, you would not have a deduction under the old law because your total medical expense is less than your $10,000 threshold. But now, your threshold is $7,500 for 2017. And with $9,000 of medical expenses, you have a medical expense deduction of $1,500 under the new law. The deduction for state and local taxes has been limited under the new law. Before, you could deduct all of your state and local income taxes and property taxes. The new law now limits your deduction to $10,000. This limit does not include business state and local taxes deducted on business returns and business schedules. Mortgage interest expense has also been limited. The amount of mortgage interest expense that you can deduct is limited to $750,000 of new indebtedness. Mortgage interest on indebtedness incurred before December 16, 2017 will continue to be deductible on debt up to $1 million. The deduction for home equity interest has been suspended for 2018 through 2025. Taxpayers could deduct interest on $100,000 of home equity indebtedness in 2017. The new law makes it easier to deduct cash charitable contributions by increasing the income limitation from 50% to 60% of income. The increased limit means that taxpayers can deduct more charitable contributions per year. You can deduct cash charitable contributions up to the limit. Any amount over the limit will carry over to next year. This change will not affect many taxpayers because very few taxpayers give more than half of their income to charity. Speaking of charitable contributions, the new law eliminates charitable contributions for college athletic seating rights. So now a charitable contribution is not allowed for any payment to a higher education institution when the donor receives the right to purchase tickets or seating at an athletic event. Starting in 2018, casualty losses can only be deducted for losses associated with federally declared disaster areas. All other casualty losses are suspended, and deductions for theft losses are suspended as well. All 2% miscellaneous deductions have been suspended. These deductions include tax preparation fees, investment fees, and unreimbursed employee expenses. In addition to the changes made by the Tax Cuts and Jobs Act to the various itemized deductions, the law increased the available standard deduction for all taxpayers. With this increase, it is expected that many more taxpayers will use the standard deduction instead of itemizing their deductions in 2018. According to the Tax Policy Center, taxpayers itemizing their deductions would fall from 44 million in 2016 to 20 million in 2018, the first year the law is in effect. Finally, the new tax law made a few changes to the adjustments for AGI. The deduction for moving expense has been suspended, except for certain Armed Forces members. Alimony payments required by a divorce or separation agreement executed after December 31, 2018 are not deductible, but the payments will not be included in the spouse's income. The deductions for student loan interest, qualified tuition, and the $250 educator expense remains unchanged. While Congress discussed the elimination of many deductions, very few were actually repealed or suspended. And that may be the biggest lesson of 2017. Once you give taxpayers a tax deduction, it is very difficult to take it back.